Those of you that have followed my commentary before, and if you don't, a lot of this stuff is on www.shadowtrader.net. A lot of it is there for free. There's an archive section where there's videos that show you how to set up these charts using TOS. TOS is a little bit unwieldy, I think, for these, which I've complained about, but I'm sure they're looking into it. In terms of like Saturday here, you know, I have to be honest with you. I generally have these up on another charting package, and I like to use the platform just for trading. I kind of keep it separate. But TOS has managed to recreate at least, or put in the symbols that are necessary to look at the market internals as best we can here. So I'm going to go through very slowly what you're seeing on these four screens, and then we'll look at how it can help you interpret intraday direction. So basically, going in a clockwise fashion, starting from the upper left, this is what I call the U-vol-D-vol, and this is the relationship between the up volume and down volume on the New York Stock Exchange. Everything that you're seeing here is all NYSE. You know, NYSE, I call it NYSE. All these are New York Stock Exchange. This one here is the advanced decline line, which is the advancers minus decliners. Again, on the NYSE. So it's stocks that are up minus stocks that are down. And this is in absolute numbers. So these are actual numbers of stocks. And this y-axis here on the U-vol, okay, these amounts are in 100 million share blocks, just so you know. So if this is up here at 2.5, okay, that's 250 million more shares going into stocks that are moving up rather than going down. We call that up volume, volume flowing into upward moving stocks, or volume flowing into downward moving stocks, okay? Now, these absolute numbers here on the right, in terms of the U-vol, D-vol, and the breadth, I don't want you to get too hung up on them. They're really relatively meaningless. It's really more about the pattern and how we tie in the pattern relatively to what's happening on the chart here in the lower right, which is your futures chart. You can use SPY, can be whatever, doesn't matter. Any broad market action will do. Generally, use the S&P because it's probably the best benchmark for what's going on in the NYSE, okay? So we have here in hundreds of millions of shares. Here we have in actual numbers, and this is the ticks on the NYSE, which is also in actual numbers. So this is at any given moment what stocks are upticking. Remember, a tick up is simply a print at a higher price, right? Not when the bid increases. It has nothing to do with the market, meaning the bid and the ask. But when a stock actually prints a higher price than before, that's considered an uptick, right? So a trade was made at a higher tick. So when that happens, we get a positive tick on the NYSE. If it doesn't, if it's a down-ticking stock, you get a negative stock on the NYSE. And every, I'm going to say 7 seconds or so, approximately, don't hold me to that. I'm not quite sure, but I think it's somewhere between 7 and 15 seconds. This is updated, and it plots here. So usually what happens is these numbers fluctuate between plus 1,000 and minus 1,000. And these are the parameters that we really need to watch most closely, is just the plus 1,000, minus 1,000. I'll get into that shortly, why that's important. And over here, like I said, this is my broad market chart. So I have ES futures here, and again, it's on everything is on 15 minutes, by the way. It's very important to keep your time frames the same, so everything is kind of locked up. And again, this is showing obviously futures data from overnight, whatever, but we're mostly going to be interested here from 9:30 to the close. Okay, so that being said, we've created the building blocks, if you will, of the market internals. And why we are watching these things, or why we're even interested, is because what I do as a day trader and as a longer-term trader, in terms of when I know that I want to get into a position or get out of a current position, and again, I said that's why this ties in very well with Robert's SPX strategy on the butterflies, is that I'm looking for convergence or divergence in these three areas right here, with the breadth, the advanced decline line, and the ticks, with what's going on here in the ES. Okay? And when I say convergence and divergence, I mean that if something is happening in the broad market, meaning we'll call that the ES here, we'll call this the broad market, I need to see the same action happening here that confirms the action in the broad market, so that I know that the action in the broad market is sustainable, that i.e. it's going to keep going in the direction that it's going. You know, too many people, I think, are just really baffled by the market during the day, and then they use that old saw where they say, well, I'm not a day trader, so I don't really care. Well, how are you going to put on a swing or whatever or I should say, why would you put on a swing trade if you had a really strong feeling that the market would be lower a half hour from now? It just doesn't make sense because you would get so much better price improvement and such a better entry. And not only that, what if the market was lower 30 minutes from now, and then the stock that you were looking to get into long at that point didn't budge an inch during the time that the market went down? You know, you kind of knew the market would go down. Maybe you flipped some futures short during that time period. You hit a couple contracts for a few ticks, whatever. But at the same time, you're looking at some stock that you like long, and that stock doesn't budge. Well, that's also really strengthening your case, isn't it? That's the classic relative strength, you know, move. This is something I like very much in the markets. I'm very, very interested in any instrument, you know, stock, future, whatever option that's not acting with the market, that's actually acting stronger than the market, right? That's really important. If I want to go in that direction, I don't just want something that's going to produce the same gain as the market. I want more bang for my buck. I want something to be outperforming the market. So in general, I'm just trying to stress how these things definitely tie in with longer-term trading, okay? So that being said, the three building blocks, as I said before, are the breadth, the advanced decline line, and the ticks. Now, these three indicators have what I call hierarchy. And what I mean by hierarchy is very simple, that they that some are more important than others, and they have to be looked at in order, and some take preference over others. Those of you that follow my commentary on shadowtrader.net and have read some of my newsletters and the broadcast know that I often use the term king for the breadth, and I use the term queen for the advanced decline line, and then I use the term prince for the ticks. Why, I don't know. I just figured that was just made sense, right? Just the level of royalty going up, whatever. So knowing that the breadth is the king, what that tells me is that I never want to be involved in any move that is against the breadth. The market will generally mirror what's going on with the breadth almost all the time. I say almost because nothing is foolproof, obviously. There's always going to be news-driven events. There's going to be areas of huge volatility where things just won't make sense. But remember, in trading, it's all about odds. There's no such thing as a free lunch, and there's no such thing as a sure thing. There is no such thing as a strategy that works 100% of the time. There is no such thing as an indicator that works 100% of the time. You can only find strategies, indicators, and tools to help you that work a majority of the time, and then you play them all the time, and then your job is simply to manage risk and lose less during those times when they don't work, and, you know, win the full amount on the times that they do. That's all you can do. But in general, I would say that the predictive capability of the breadth here, of the relationship between the up volume and down volume on the New York Stock Exchange, is very, very strong in terms of predicting how the broad market's going to go. The second one, as I said, is the advanced decline line, right? Relationship between advancers and decliners on the NYSE, and again, this is in absolute numbers. Now, right off the bat, if you want to write some of this stuff down, you want to know that absolute levels close to the 2,000 mark tend to be unsustainable. Okay, tend to be relatively unsustainable, and they usually happen early on during gap moves. Okay, so this is key to note because Friday morning we had a classic example of futures that moved up strongly, and you don't really see a gap here because this is the ES, but if it was a spider, you'd probably see it opening somewhere here, right? You see a market that moved up strongly only in the first 15 minutes of trade and then failed miserably.